And good evening. We are doing it live right here, weeknights in the 5 o'clock hour in Los Angeles. Mottek on Money, 5 nights a week for you, live on the air on 790 KBC, streaming live online worldwide at KBC.com, and the on-demand Mottek on Money podcast for you at KBC.com, Apple, iTunes, all your favorite podcast platforms. Let's get right down to business this evening. Stocks managed to score their first gains in 5 trading sessions. It was a rough week last week. We saw a seesaw session today, starting the new week. Looks like those bond yields continue to rise, impacting fixed-rate mortgage rates. Definitely nervous time in the real estate business again. The Federal Reserve signaling plans to hold interest rates higher for longer. Trading volume lighter than usual today on this Yom Kippur holiday. We did finish higher following a seesaw session. The Dow coming in for a closing gain of 43 points. The S&P 500 up 17, and the NASDAQ gained just about 60 points. Last week, we saw the S&P 500 give back nearly 3%, the biggest weekly drop since the time when we saw those bank failures back in March. And the S&P 500 ended the week at its lowest level since June. We are seeing bond yields continue to rise, including today. The yield in the 10-year note is now the highest we've seen since October of 2007. During the financial crisis days, 4.54% today. That's the one that impacts the fixed-rate mortgage rates. Also, a housing crisis in China back in focus, with Evergrande shares ending about 22% lower today as that big property company in China scrapped a debt restructuring plan, while shares of China Aowan Group closed down by 72% in its first day of trading in more than a year. Big news, of course, here in Hollywood, as you've been hearing all day long, tentative end to the Hollywood writers' strike. Will this really be a Hollywood ending to the strike? Well, we did not see any big reaction among the media companies today, like Warner Brothers Discovery, for example, and Walt Disney, which each saw their shares end a bit lower today. Netflix and Class A shares of AMC Entertainment Holdings finished about, for Netflix, it was up 1%, and for AMC, nearly 7% higher, as investors embrace streaming and movie theater chains in today's action. Now, we'll talk about, of course, what's going on with the writers' deal with the studios and where things go from here with the actors still on the picket lines. We'll talk about it. Talk about the hot labor summer, now the still hot labor autumn, with JONATHon, HANDEL, entertainment and technology attorney, who's been following all the twists and turns in the Hollywood labor drama. And following this program, it's the 790 KBC News Blitz, and our legal eagle, Royal Oakes, will be hosting it tonight. And Royal Oakes will be joining you in the 6 o'clock hour and covering that as well. Now, is oil going to $150 a barrel? Analysts at J.P. Morgan Chase, as well as other analysts, are making that prediction now, seeing oil essentially hitting record highs soon. What would that look like at Southern California gas pumps, where prices are already nearly $1 a gallon higher than where they were a year ago? We'll get an update tonight. Thorough update from gas and oil industry expert John KILDUFF, with again Capital and CNBC contributor, longtime contributor to this program. But first, on your money, the markets, the economy, and the whole works tonight. Joining us live now, money manager Ken WINANS, president of WINANS Investments, market historian. His books include Investment Atlas 1 and 2. He's also a Forbes magazine contributor. His latest article in Forbes right now is titled Buy the Dip. October is usually good to investors. Ken, thank you very much for coming to the line, and congratulations on your latest article. Given that rough week we had last week and positive start today, give us your view of things here at the moment.
Frank, this market has been unbelievably seasonal all year long. And what I mean by that is there's a certain tendency for the market, even amongst years and geopolitical crisis and other things, to have a certain bend to how things trade. So a good case in point, although this summer did have some very powerful rallies, we certainly saw some pullbacks. This last quarter ended with a giant goose egg. Also, if you're willing to look past the NASDAQ and the S&P 500 and look at other market benchmarks that are broader, including the Russell 2000, the Dow Jones Industrial Average, the S&P 400 Mid-Cap, they're all trading in low single digits. So this has been a choppy, mediocre year in a lot of respects. And so when I wrote the article, it was really meant to put a historical context of what typically happens in the fall, because a lot of people are frustrated with the knowledge that even with the tech stocks, the market is nowhere near its old high of December in 2021. And now we're talking about several years down the pipe, but we need to get ready that it might be more of this. But anyway, the gist of the article is there is some good news. Even in spite of all the horrible things certainly a lot of things you just rattled off, they're not positives. The market typically rebounds even in bad years to give some very impressive rallies. So the buy the dip is seriously what I told everybody. Don't focus on October, although it can be volatile. You should be putting your list of investments together and begin to say, hey, maybe I need to put some of that cash to work.
Historically, September is a rough month, right? As we are about to say goodbye to September, it looks like it will be a losing month. And there's that famous market adage, sell Rosh Hashanah, buy Yom Kippur, and kind of a seasonal pattern there, right? What are your thoughts about that? That's been around for more than 100 years, right?
Well, anybody who's not Jewish better go back and study their holidays, and because there's a lot of them there. But you're 100% right. I mean, everybody focuses on, and it is true that we've had some awful Octobers. You and I have been party to that many, many times. But September is statistically the worst month of the year for the stock market over a long period of time. In my case, I've taken it back to 1970 to try to include the inflationary 1970s. And it's true. It's an awful time. And the old adage, sell in May and go away. Well, again, you have to step it back in, and it's usually right after, September, you want to look at it. But Frank, with that being said, let's also talk about what are the drivers. You just mentioned the strike in Hollywood coming to an end. I'm actually of the opinion that the automotive strike will also come to an end sooner than later. I think those two things plus earnings, that we're going to start getting a whole slew of earnings coming out over the next 3 weeks. And we're going to find that although they're not great, they're not horrible. And what I mean by that is that their companies are going to say that in spite of the higher interest rates and the cost of borrowing, even at the company level, they're still managing to maintain their profit margins. And I think that kind of news will help move the market forward.
On the Air Live with money manager Ken Winans. Getting back to October, of course, October known for those pretty ugly events in market history. 1929, the market crash, and then 1987, which many of us still recall. And then, of course, there was the good old financial crisis back in October of 2008. What is it about October that has all of those marks in history?
Well, here now, Frank, on the opposite side, we actually met history last year when the Dow Industrial Average shot up 14% in October. That was a 57-year historic mark. So it is. What I can tell you is that October is the wild card. It is just one of those things. It's usually earnings driven. There's usually some surprise that happens. I mean, I remember distinctly in October 2008, it was when the jury was finally realized that, hey, the world's not done yet. After Lehman Brothers, we have other things happening. But it's just, the hows and whys sometimes are not important. It's just the reality of what happens. And we should just, again, I would just say if we have any volatility this month, I think we're certainly going into next month, you should just consider putting some money to work and taking advantage of some things that might be bargains. But I do not think, and I've been cautioning everybody that, we are not in a bull market right now. We're not in a bear market. This is what we would call a channel market, and there will be good, bad, and ugly. And I would just simply suggest for people that they need to get serious about thinking about their strategy really for what's ever left of this year going into next year, and just readjusting for the realities of today's world, not what worked for the last 30 years.
Right, and that means higher interest rates, higher for longer, it looks like. And look at those bond yields, and look at those mortgage rates here now, Ken. And what about all that? And now, obviously, the bond market competing for stock market money here with those kind of yields.
Absolutely. Well, and then you bring up a good point. A lot of companies are finding they're going to have to raise their dividend yields to compete. One of the things that's loud and clear, the housing stocks, which had been a real pillar of strength even since last year, all just went into a nosedive as mortgage rates began to come up. So all those big home building companies are going to have a tougher time selling houses. Prices will continue to soften in a lot of areas of the country, especially where there's high taxation. But no, Frank, higher interest rates, and there's a lot of different ways you can look at this. Yes, they are high for what a lot of people remember. But if you look at it historically, these rates are still very much in the mid-range. And so money sitting around should not be not earning anything. The problem is if it starts earning too much, you're right, people don't buy real estate, they don't buy stocks, they just simply lend money out. So I think that as we go into next year, now the good news is going into next year, the Federal Reserve is eventually going to say they're done. Now, they're not going to lower rates, but they're going to basically say we're not going to raise anymore. And basically the money supply will even out. People get used to the interest rates, and there won't be any more of a guessing game on how high it's going to go. I think that will happen in the spring. But we just have to grin and bear it for the rest of this year.
All right, inflation, obviously, another big subject here, and we're looking at oil prices still hovering around $90 a barrel. Some are predicting $150, which would be a record high. You're one of us here, Ken. I know you pay California gas prices, so you see what's happening at the pumps here. What do you think about gas and oil prices, where they're going, and from the consumer standpoint as well as from the investment standpoint, where would you be placing your bets?
Well, here's the thing. When we're going to talk about oil, I think we also have to talk about natural gas, because there's a tendency for people who drive hybrids and EVs to think that this does not affect them. Most people don't have solar panels on their roof. They are dependent about plugging their cars in to a power grid that's still tied to natural gas. We will all be looking at higher prices going through this next winter, and that is assuming we don't have any kind of catastrophes, whether they're fires, whether they are floods or anything else. But energy prices overall, I think, will continue to rise. And in fact, it's been one of the areas that I've been adding to my portfolios. It is a little unusual to have oil climbing this late in the driving season. I would have expected it earlier this summer. But the simple fact is it is a supply and demand issue. It's what's driving everything right now. 150, I think that's a stretch, but I certainly think we're certainly thinking that oil is going to go back to the lows it was earlier this year. I don't think we're going to see that for a long time. Again, everything is finding its normal equilibrium. And there's a lot of commodities. I mean, before I've talked about things like a lot of the agricultural commodities like sugar. Sugar is up 60% in the year 2023. That is passed on to food prices, and certainly when you go out to eat. So unfortunately, the cost of living, the cost of entertaining, the cost of doing whatever we do is going to go up and continue to go up for the foreseeable future.
On there live with Ken Wines, another big story. Ken, and no conversation is complete nowadays without mentioning AI. Today, Amazon taking the spotlight, saying it'll invest up to $4 billion in artificial intelligence startup Anthropic and take a minority stake in the company to accelerate the development of its future foundation models and make them accessible to customers of its cloud business, AWS. Amazon stock did move higher in an otherwise down market. What about that big news, and what about the latest developments in AI?
You know, the AI story is, if you're going to look at it as I am a company and I want to reduce my cost, and because of government mandates and taxes, they're making it just too darn expensive for me to hire human beings. Technology has always been an ample substitute. And by the way, this is not a current development. This goes back to the Middle Ages of Europe, when the Great Plague wiped out so much of the population that you needed machinery to move the economy forward. So this is an age-old thing. And I think the AI phenomena is driven by companies looking for intelligent ways to keep their companies moving ahead efficiently and effectively and driving their costs lower. So it's not a surprise from that standpoint. But as one caveat, I've been in this game a long time. I spent a great deal of my time in the San Francisco Bay Area. I'm used to the razzle dazzle that comes out of Silicon Valley, and they're all.
Afford Anything talks about how to avoid common pitfalls, how to refine your mental models, and how to think about how to think.
In the world of money and investing, it can be easy to be dogmatic about your beliefs. You're part of the FIRE movement, financial independence, retire early, or you hate it, you hate it, you hate it. And either you embrace credit cards as a route to getting airline reward, or you follow the Dave Ramsey camp and believe that you shouldn't touch them because if you play with snakes, you might get bit. Afford Anything, wherever you listen.
Always great promoters of things, and their enthusiasm is well-founded, but it's usually ahead of its time. I mean, there's still a lot of issues with AI that we're going to have to work through, especially in my industry. When I talk to the programmers in this field and I ask them about the basic set of assumptions they've used in programming their technology, like people, AI has its biases, and it's based on how things are fed to it. And as far as learning new things, again, it's based on biases. And I do find that a lot of those biases, at least in the real world of investing, they're going to have to fine-tune it a great deal for it to be real useful.
And, of course, AI an issue in the writer's strike, which looks like they have a deal now with the studios. And, of course, it's still an issue with the Actors Union as well. What about the initial reaction we've seen, at least here, for some of the big studio names, kind of a muted reaction to that tentative end to the Hollywood writers' strike? What are your thoughts on the media stocks here at this point?
You know, Frank, I watched the news as well as you did today, and the thing that kept everybody kind of worried about is what are the earnings going to look like next month? So I think that people are kind of holding their breath and just hoping it won't be horrible. And so I think once those earnings are out and we can actually see what the projections look like going forward post-strike, you might find these stocks begin to move. I know that I have been buying some of the Hollywood names in the strike itself. I mean, I think I brought up before, Paramount Global has a preferred stock that was yielding some ridiculously high dividend. I think it was north of 14%. And I mean, Paramount is a very stable part of Hollywood. It's certainly going to be around for a long time. I mean, I look at things like that. I look at Icon Enterprises that funds a lot of things in Hollywood. They had bonds that were paying north of 10%. So I think that there's still opportunities there, but I think it's all driven by what are earnings going to look like and guidance for 2024. That is what everybody's focusing on right now. It's in many, many ways is actually more important than the interest rate story. It's what has this done to the earnings of America's big employers, and we're going to find that out very shortly.
All right, at this point, Ken Winans, any other specific places where you are putting money now and or taking it off the table?
Well, I'm going to give one name tonight that I think people should take a look at, and I'm not one to promote exchange-traded funds, but there's one of them that's been around a long time that I think it's 65% of its component is tied to crude oil. It is the DBC Commodity Index, symbol DBC. If you want to play the oil run and you want to do it without betting on a company and you're betting on just the pure commodity, I would take a good hard look at that. It's liquid. You can buy it at any brokerage house. It's fine. If you're looking at specific names, the name that keeps coming up in my models is Hess. I mean, for a lot of people in California, they don't know who they are, but they're a mid-sized, very old oil and gas company, symbol HES. Take a good look at them because they're doing a lot of things right. If you're looking at one of the big guys, I would seriously look at ExxonMobil. Based on, the one thing that we're finding is that Sacramento is waging war against any company in the energy sector now. And I think that's my one concern about buying Chevron. It just seems like they're being penalized for being in business. So I generally would avoid California-based energy companies because I think that they're just going to continue to get hit with fines and fees and taxes just because of a difference with Sacramento about the product that they make. But ExxonMobil, I would certainly take a good hard look at that.
All right, Ken, thank you very much for taking the call live with us here tonight. That's Money Manager Ken Winans, president of Winans Investments, market historian. His books include Investment Atlas 1 and 2, and he's also a Forbes magazine contributor. His latest article posted on Forbes is titled Buy the Dip. October is usually good to investors. Ken, thank you very much for joining us live here tonight.
Thank you, Frank. Good night now.
Good night. Thank you very much. Folks, the future of joint pain relief is here. It's QC Kinetics, advanced regenerative medicine. Amazing stuff. It's Frank Mottek here. You've been told more steroids or surgery are your only options. Don't be so fast. Get a second opinion and learn more about how you can harness your body's own healing agents to attack that joint pain. I'm talking lasting relief. QC Kinetics does not mask the pain. These treatments go to the very root of the problem using concentrated healing properties placed directly in your joint to restore and repair that damaged joint tissue. Imagine living your life this fall with no more pain in your knees, hips, shoulders, or back. No drugs, no downtime, and no surgery. Life is about motion, and QC Kinetics is giving people their lives back with these all-natural treatments. Call QC Kinetics for a free consultation, the nation's leader in regenerative medicine. QC Kinetics, locations in Glendale, the city of Orange, Mission Viejo, now also in Costa Mesa. 213-997-PAIN. 213-997-PAIN. Again, that's 213-997-PAIN. Mottek on Money continues here on 790 KABC. Good evening. Stocks finishing higher today in a seesaw session, trading volume light. The Dow 43 points at 34,007. The S&P 500 of 17 to 4,337. And the NASDAQ of 60 at 13,271. The yield in the 10-year note is at the highest we've seen, in quite some time, since 2007. That's the one that impacts the fixed-rate mortgage rates, and it is moving higher as well as the price of oil still elevated above $90 a barrel. And we did get some big predictions today, including one from Doug Lawler, who's the chief executive of Continental Resources, a shale drilling giant controlled by billionaire Harold Hamm, telling Bloomberg today that he sees crude oil prices could hit $150 a barrel. J.P. Morgan Chase analyst also seeing Brent crude in London possibly going to $150. We'll take a closer look at that big story this evening with oil industry analyst John Kilduff, who'll be joining me live later this hour. We are watching the price of oil impact gas prices here, with regular in Los Angeles now averaging $6.12 a gallon. In the L.A. Long Beach area, $6.45, the average price for premium, both nearly 80 cents a gallon higher than what you were paying just a month ago. And diesel now at $6.46 a gallon on average. Taking a look at the cryptos now, we see a Bitcoin down about $20 at $26,271. Ethereum up $1 at $1,587. And Doge at 6 cents. Big news here in Hollywood with the Hollywood writers' strike, a tentative end, failing to lift the studio companies today. Warner Brothers and Walt Disney saw their shares end a bit lower today. We'll be taking a look at that big story coming up here shortly as well. We're also watching the UAW strike. President Biden expected to join UAW union members on the picket line tomorrow in Michigan as they strike against the big three automakers, Ford, GM, and Chrysler owner Stellantis. We see GM shares moving up a bit today at 48 cents at 33 and change. Ford at 15 cents at 12.58. And Stellantis shares, let's see if we can bring that one up here, down 12 cents at 19.24. Mottek on Money continues here in 790 KABC. Good evening. Well, after nearly 150-day strike, it looks like a deal has been reached between union writers and the studios here in Hollywood. Talks between the Writers Guild of America and Alliance of Motion Picture and TV Producers resumed last week after months of starts and stops, and it looks like a tentative deal was announced last night. SAG-AFTRA, the actors union, which has been walking with the writers since day one of the WGA strike, was quick to congratulate, I should say, the Guild after reaching a tentative agreement, as negotiations hopefully will start up at some point between the studios and the actors who are still on strike. Following all of this very, very closely, the hot labor summer, now the still hot labor autumn, Jonathan Handel is with us now, entertainment and technology attorney, who's been following all the twists and turns in this Hollywood labor drama. Jonathan, thank you very much for coming to the line. Is this a Hollywood ending for the writers here with their strike against the studios?
Well, Frank, it's good to be with you. And we go back some ways when you were at a different station here in L.A., and I think back to the last writers' strike. So it's a pleasure to be back with you.
Likewise.
And the answer to your question is it does seem to be a Hollywood ending for the writers. They got more than one might have anticipated. We know some of the details that have leaked. They haven't officially released details yet. But, you know, the bottom line, this is a hot labor summer, and we've got 3 big contracts expiring next year as well, not to mention the video game contract between SAG-AFTRA and that industry, which they may the strike authorization vote is coming in actually within an hour or so, and they may go out this week. So, you know, the idea that the studios could outlast writers who survived 2 years without agents when they were campaigning against talent agencies, or actors who, you know, 50 auditions and you might get one job that they go for a long time. The idea that you could starve these people into submission was always a doomed mission to a dead planet. And so this really is a situation, though, where everyone wins as the industry gets back to work, in part. And as we say in part, because as you point out, the actors are still on strike.
On your line with attorney Jonathan Handel, and leading up to the strike, things had come to a standstill already months before, right? So it's been a very rough year for everyone in the Hollywood industry.
Everyone in the Hollywood industry and adjacent, you know, the restaurants, the suppliers, the prop houses, on it goes. And of course, it's not just the striking workers that are idled. It's the crews, the directors, everybody. And it's been very difficult for people. But the only thing more...
Introducing Rich Valdez, America at Night, the podcast.
Welcome to the conversation, familia.
A perfect blend of news and entertainment, interviews and insights.
Eye-opening, nothing very surprising, but definitely eye-opening.
America's nighttime town hall whenever you want.
What else could it possibly mean?
Rich Valdez, America at Night.
Let's get to the meat and potatoes of it.
Follow the podcast wherever you listen.
Difficult than not working for many people is the difficulty of working when you don't feel that you're being paid fairly, or that your job might be taken away by a Silicon Valley bot, a piece of AI. And of course, that was one of the issues in the strike.
Right. Do we know anything about how the AI issue was addressed?
We do. We understand that the writers got certain protections, but not quite everything they were looking for. So, for example, a script written by AI will not get credit on the screen. If a writer rewrites a script that was written by AI assigned by the studio, the writer's output will be considered an original script, not a rewrite. And on the other hand, the training of AI systems using existing writers' scripts, and that's, of course, how these systems work. They're trained with input, with writing or with images or whatever it is, depending on the system. The writers wanted, it wasn't clear whether they wanted to prohibit that or whether they wanted compensation if their script was used. But in any case, they did not get that. The studios, on the other hand, did not get the blanket right to do that. The parties agreed to disagree and kicked the can down the road.
And certainly AI an issue here with the actors, where the images and likenesses, certainly seeking additional protections for all of that, including voice work, by the way. How do you think that's going to impact the actors' negotiations with the studios?
Well, that's right that it is a difficult issue for the actors as well. But there are two other things to know. One is the writers got additional compensation for successful streaming shows. All streaming shows get residuals, royalties for writers, actors, directors, but they wanted additional payments in for the hits. The actors want the same thing, but they want a different approach that would look at the revenues of the platforms themselves, Netflix, Disney Plus, what have you. The studios don't like that approach, and that may be a stumbling block. But ironically, the biggest stumbling block may turn out to be one that doesn't have the glitz and sort of glitter that an issue like AI or even residuals does. That is basic wage increases. The writers were looking for 6%. The studios offered 5%, which is what the directors took in their deal. There was some compromise there, presumably. But the actors are looking for 11% because of the inflation that we've had. That's down from their initial ask of 15%. And here's the thing. The basic wage increase, the increase in minimums that have to be paid, is 85 to 90% of the value of the package. So the studios are going to be very concerned with that dollar value and the bottom line. Not only that, I mentioned that we have 3 contracts expiring next year. All 3 of those will be looking for, have issues around the minimums, and they will be looking at what goes on in the SAG contract here as a signal for what they should demand. Those contracts include two very big ones: the IATSE crew contract, and if the crew go on strike, it shuts the business down again, and the Teamsters contract. They're the truck drivers who haul the equipment. If they go on strike, the business shuts down again. So this hot labor issue is not over. It really is a degree of income inequality and wealth inequality in this country that is breaking people's backs, and they're not putting up with it anymore.
Certainly, and the cost of living here, especially in Hollywood and the greater Los Angeles area, of course, a very big factor. As you drive by the studios, you see a lot of homeless encampments on Hollywood in Sunset, certainly, and near Paramount there on Melrose, and it's pretty heartbreaking to see the reality out there.
It really is. I mean, somehow we've accepted a system where some people can accumulate hundreds of, not millions, but even hundreds of billions of dollars, while others starve in the streets, sleep on the sidewalks, and many of the people who drive by them to work or take a bus by them to work are working multiple jobs and struggling to keep food on the table and a roof over their heads in one of the most expensive cities in the country. There's a point at which we've passed the line of immorality with that degree of inequality in this country, and it's grown over the last 40 years, and especially the last 10 years with the rise of tech billionaires and millionaires.
This tentative deal that we were just discussing between the Writers Guild and the producers is a tentative deal, and it still has to be approved by the rank and file. Will there be any surprises here? You think it'll be approved?
Oh, it'll be approved. There's no doubt about it. There's no surprise. The only surprise will be, will it be approved in the 80th percentile, the 80%, or will it be in the 90%? So if opposition emerges, it could be in the high 80s or mid 80s or something. Otherwise, it'll probably be in the 90s. The board has to vote. The board will vote for it. and then the members get to vote. And while the members are voting, usually they can't go back to work, but the board also is going to be deciding tomorrow whether to lift the strike itself so that members could go back to work maybe as early as tomorrow or the next day. But that does not happen unless the board makes that decision. Otherwise, you have to wait till the ratification is done.
And what's the outlook on the actors at this point?
Well, you've got these difficult issues, as I pointed out, the wage increases, the AI issue, and the residuals issue in successful streaming shows. So I think it's going to require, again, at some point, the involvement of the CEOs. And I really fault them for not having gotten involved 150 days earlier before the writer's contract even expired. We didn't need these strikes. What we needed was a new playbook and a new understanding from the studios of the moment that we find ourselves in, and that labor is not going to, roll over or compromise to the degree that it has in the past. They didn't read the newspapers or get the message, and as a result, we ended up with not one but two lengthy strikes. I hope that lesson, at least belatedly, has been learned, and that we will get a Screen Actors Guild deal. And when we do, it's not going to be instantaneous either. Again, the ratification, the voting process, and rebooting production. Just scheduling one movie in the ordinary course of business, it's difficult. You got to coordinate all the inputs, the director, the actors, the crew, the equipment, et cetera, the locations. But now imagine something like 1,500 productions all hearing the starting bell at the same time and all competing for overlapping resources. I have the actor in January. No, I have the actor. Well, I'm going to call your studio head. Well, you go ahead and do that. You can just see what the conversations will be like one after the other, and it's chaos.
Jonathan, thank you very much for that thorough assessment of the big news here. And we've just seen the actors and writers on strike for the first time since 1960. Looks like the writers have a deal now. Let's see what happens with the actors. Thank you very much for that thorough analysis and assessment here tonight on the big story. Jonathan Handel, entertainment and technology attorney, has been following all the twists and turns on the Hollywood labor drama. Great to reconnect with you, Jonathan. Look forward to talking to you again very soon.
Likewise, Frank. Thanks.
Thank you very much. If you're injured in an accident, you need an experienced advocate. And Clark Fielding and his team of sharks at Fielding Law are on standby, ready to dive into your case. My friend Clark the Shark is fearless for justice and your go-to attorney when injured in an accident that wasn't your fault. Whether it's a car accident, slip, trip, fall, or any other personal injury, Fielding Law is here to make sure you get the care, attention, and compensation you deserve. Fielding Law can assess the circumstances of the case, negotiate tenaciously with insurance companies, and if necessary, file a lawsuit and litigate to seek fair compensation on behalf of you, the injured party. An injury is a major disruption in your life. Medical expenses, lost wages, pain and suffering, property damage, and other losses incurred as a result of injury are part of the damages. Don't try and handle the process alone. You need an expert in the process. The team of Fielding Law are the ones to trust. Put Clark Fielding's number in your phone right now under the word accident, 833-88-SHARK, 833-88-SHARK, or go to clarkthesharklaw.com. Mottek on Money continues here on 790 KABC. Good evening. Give me 150 on pump number 2. A lot of you are saying that already. Filling up an SUV or big luxury vehicle out there. It's getting more painful to pay at the pump these days, with regular gas in Los Angeles now averaging $6.12 a gallon. $6.45 the average price for premium, and $6.46 for diesel. The regular and premium price, by the way, about 30 cents a gallon below the all-time high we were paying last October, nearly 80 cents a gallon higher than what you were paying just a month ago. Meanwhile, is oil going to $150 a barrel? Many analysts think that's where it's going, right around 90 right now. Let's bring in one of the leading experts on the subject right now is John Kilduff, again Capital, and CNBC contributor, longtime contributor here on Mottek on Money. John, great to have you with us here. You're one of the leading gas and oil industry experts in the world, and it's always a privilege to have you with us. Give us your assessment of where things are going here.
Well, you're too kind, Frank, as always, and it's great to be on with you, and great to be a contributor to your program as well. Look, we've talked about this over the past several months. It's really, there's a real vulnerability here right now for the global consumers, not just the U.S. consumers, because of what Saudi Arabia is embarking on here in terms of trying to constrain supply and drain global inventories. I want to put this in perspective for you a little bit, if I can. With the Saudis' recent cutbacks, they are producing about 9 million barrels of oil per day. The U.S. is currently producing 12. The Saudis have cut back on their exports. Their exports have plunged to about 5.6 to 5.8 million barrels per day. The United States is currently exporting pretty much on average close to 5 million barrels per day. So we talk about this behemoth Saudi Arabia, and they are. But it shows you what they are trying to do to line their pockets. And Mohammed bin Salman, who spoke at the BRICS conference there, the Emerging Markets Conference 2 weeks ago, said as much, that he wants a higher price for oil because he wants a higher GDP for Saudi Arabia, and that's coming at our expense and China's expense. And we'll see if it proves to be a good way of doing business. But for now, this is what we're up against. So when you hear people like Harold Hamm and other folks from Continental Resources talking about the potential for $150 barrel oil, this is the source of that anxiety and potentiality.
Right. Harold Hamm, as well as J.P. Morgan analyst, now predicting 150 unless there's some change in policy. And, of course, we've seen what the policy has been the last couple of years, discouraging oil production here. And we've seen the results at the gas pump prices.
I mean, it's been discouraging here, or if not crazy, Frank. I mean, in one hand, the Biden administration discourages oil production. The other hand, it encourages it. I mean, recently they opened up a patch of land up in Alaska for Chevron, only to recently foreclose a big chunk of the Alaska National Wildlife Reserve to production. I mean, the mixed signals are just, baffling and not a good look, certainly. And the problem with that is that in the markets that I deal in, the futures markets, that attitude, whatever the attitude of the administration is, whatever the signaling is about doing something or whatever policy is, gets priced in. So right now, certainly we're seeing an administration that, net is certainly trying to hold back, production, oil production, natural gas production, in search of this climate change, prevention holy grail. But it's going to cost us, and it's already costing us.
Certainly.
And again, the Saudis are the ones here who are a problem because they're at 9 million barrels right now. They could easily go to 10 or 11. And what does that then do to the market? It crashes it, and it harms investments that people like Continental Resources could try and make in a more accommodative environment. So this is no easy market right now, and we have a 800-pound gorilla in the room, Saudi Arabia, really sticking it to us much more than whatever the ineptitude here is in terms of the mixed policy statement from the Biden administration, in my view.
All right, so we got oil around 90 right now. Where do you see gas and oil prices go from here?
I do think the next, $10 or $15 is going to be hard fought, Frank. I mean, today, one of the biggest property companies in China, Evergrande, defaulted on a bond payment that is part of a multi-billion-dollar loan. If these problems in China continue to manifest themselves to the degree that they're starting to, the Saudis can cut till the cows come home, and the price of oil is going to stay flat or go lower because China is as important to this price equation as the Saudis are on the supply side. But again, there is no room for error, and I do think that we're going to touch 100 here at least, go above it a little bit for a short amount of time here in the run-up to, say, December, January, before we slide back lower, keeping our fingers crossed that the global economy holds up.
And that would mean we could see the levels of last October, the record highs we were paying at Southern California gas pumps could be tested, you think?
I do, Frank, unfortunately. What we're seeing right now is sort of a preseason scare. Usually we get this in the late February, early springtime for gasoline prices solely. But now, as you talked about, we're getting it with diesel, we're getting it with heating oil, and it's going to drag along the gasoline prices with it. And if we get oil back over 100, which I do think we are going to get for a time, especially out there in California, where talk about policy is just off the rails in terms of refineries and all that.
Right.
No doubt you guys will be hitting a record.
John, we'll be in touch very soon again. Thank you very much for taking the call tonight on this big story. That's John Kilduff with Again Capital and CNBC and longtime contributor here on Mottek on Money on 790 KABC.
It could be information to change your life forever. Or the Something You Should Know podcast could just be something interesting.
My guest is Kim Zachman. She is author of the book There's No Cream in Cream Soda. I don't think I've ever really known the story of why they're called hot dogs.
There is so many legends about the name of the hot dog. When the immigrants came over and they brought all of their sausages, they also brought their dachshunds. It really is because they kind of look like dachshunds.
Something You Should Know, wherever you listen.